Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. I'm going to go over why I think commodities are going to be in a bigger bull market than what all of us have seen already in the 2000 and 2008. And maybe you're younger than that and you haven't seen any of them, but I'm going to describe why I think that. And I've got some charts behind me. I've got the gold to monetary base, I've got the 10-year treasury yield, and I've got the privately owned housing starts, single family residential homes. That's the housing starts. And the reason I think that the majority of people have their paradigm wrong is because they've been living in a 40-year decline in interest rates. What I am proposing is that that is probably going to change. It could change. Doesn't mean it will, but it could. And it could be way bigger than what you think. The timing is unknown. Now, I've got in the upper left here the gold to monetary base ratio right here. And it's a big deal, all right? And I'm going to try to explain why this is such a big deal. Everyone's comparing this to the last bull market in commodities. They think that this is going to be some small, that was a big bull market, but it's not, I don't think it's going to be anything near what's coming. And I've done a lot of clips on this, and if you guys, I mean, you can watch on all these, on a daily basis, get all this content, but I don't know if everyone's tying it all together. What I'm trying to say here is that we could have a massive blowout commodity bull market. And I'm a big bull, obviously. And I want to try to explain why and how to tie it all together. All right. I've got the gold to monetary base on the upper left. What this is gold accounting for the money supply. Now, here's the thing that everyone's comparing to. They're all comparing to this 2000 to 2008 bull run in commodities. Here's the thing. I've got the 10-year treasury yield right here. And you can see it coming on down, and this is what everybody's comparing it to, this decline in interest rates, the 10-year treasury yield. The bull market from 2000 to 2008 was right here. This little interest rate increase, that's it right there. It's a little interest rate increase. It was a little bull market. And we're still in this declining channel of interest rates. Now, the big move here, if we can see it, is if interest rates break out of that. Because it's game on. And why is it game on? So we look at this increasing interest rate environment back here in the 70s and 80s. This is a big increase. What increased that? What pushed and drove that higher? Well, it was an expansionary phase of real estate. And I'm going to show you what that is in the one below it. But if this comes over the next 10 years, all that's going to do is force money from stocks and bonds and rotate it into our sectors. Now, we had a small rotation back in 2000, 2008. Going back to the gold to monetary base, that's this little move inside of a descending wedge pattern, a massive descending wedge pattern. What I'm proposing is that this thing could potentially heat up. And I'm talking heat up, where this thing breaks this descending wedge pattern to the upside and does a 70s to 80s recounting valuation. Now, if that were to occur, you might see $25,000 gold. Maybe, I don't know. Because to get from where we are today, if this is it's a little bit under 0.5, let's say it's 0.4, and we're going to get to 5. Let's just say it's a 10x. A 10x from today's levels is $20,000 gold. It's possible. I'm not saying it's likely. It's possible. Now, if that is possible, if we're going to get increasing interest rates and a massive revaluation of this gold to monetary base, that's a larger portion of the component of commodities than the supply-demand curve. And you're going to have the supply-demand also go on top of that. Now, in some of these commodities, we are exhausting them. Peak oil could potentially happen in this time frame. I don't know. Maybe, maybe not. Uranium, what happened during the last uranium bull market? The last uranium bull market had decommissioned missiles. We had Fukushima happen, shortly thereafter. What's going to slow this price move down in uranium? Has anyone thought this through? What's going to slow it down? The end users of uranium, the nuclear power plant people, the utilities, do they care about necessarily the price of uranium if they're going to actually stop the nuclear power plant? They can't stop those. They're going to have to buy at whatever price that people are willing to sell. Could it get into a situation where everyone's fighting for physical uranium? The financial sector of the Sprott Fund, the utilities, going on contracts, and then what if we build all these new nuclear power plants that we already have in the pipeline? And it's not fast to get these mines up and running. What is the cost if these guys get into bidding wars against each other of shutting down a nuclear power plant? What is the cost? How much would they pay for uranium? What would the ceiling be on the utilities where they had to shut down a nuclear power plant? How much would they pay for a pound of uranium? $1,000, $2,000, $10,000? I have no idea. I have absolutely no idea. But what I'm trying to get at is, if a scenario like that happened in a short term, remember, it's like people think that we can just start extracting uranium out of seawater. Yeah, maybe 20 years from now. What about between now and then? Maybe it's 15 years out. I don't know how long. It's not going to be 5 years out. And what if the problem happens between now and 5 years? What if it's a year away or 2 years away? And I don't know I don't have the answer, guys. But what I am asking you guys to think about is that if this thing revalues way up, like it did in the 70s and 80s, and on top of it, we have bigger problems with no inventory of some of this stuff, what happens if there's a deficit, and who gets shut out? And what's the cost going to be? I don't have that answer. But it's a heck of a lot more than 140. I can tell you that. And if you get this commodity, if you have inflation come, that's just money flooding into the system, making everything worse. I don't think there's a chance that we're going to stay under 140. That's my opinion. I don't know when this is going to happen. I'm in the multi-$100 camp. Maybe 600, 800, 1,000. I don't know. Is that ludicrous? Maybe it is. I'm trying to get the head wrapped around the possibilities. I think everyone's kind of just like, they're just going to do whatever. I don't know. I'm not in that camp. I leave the potential for it to go crazy. Because when everybody piles in all at the same time, and remember, we have computers, we've got information that flows very quickly. Everyone's going to pile into this, I think. And it's a very small sector. And on the actual demand side, it's not like they're going to just stop buying at $100. They're going to be like, I have to buy it. If something's going to run out, they're going to buy it, I think. So I don't know. And I think with this in the background, that gold to monetary base, oil is going to go shooting higher too. A lot of these commodities are going to go far higher than what I think most people think. And here's the new privately owned housing unit starts here. Here it is. The red circles are the commodity buy signal for the commodity to stock ratio at the beginning of every single expansionary phase of real estate. Expansion, and then we have an expansion phase coming right now. This was a huge inflationary period. They cheated the money supply, cheated it, and then it accounted for it. Now we've been coming on down. Will this break and move to the upside? Maybe. We'll have to watch and see. But I've got another clip here. And something that is pretty crazy is I compared, and let me pull it up right now. I compared the gold to monetary base. I'll come in here. I compared the gold to monetary base right here. Now watch this. This is the gold monetary base and this pattern here, right? I have Bitcoin's consolidation phase here. And guess what? We are right where this circle's at. This move, where it comes on down and consolidates, matches this entire consolidation move to the T, and we're right where the circle is. Zoomed in on this tip over here from about 2000, a little bit before 2000 and on, 95 in the 90s to 2000. This is this section in here. This entire section is this section here. And we're right at the tip where the circle is down here, where it's about to go higher. I think interest rates are going to go higher, and I think gold's going to account for the monetary base. And I think they're going to print money and have to have it be an inflationary period. And we're in an expansionary phase of real estate. What is the most inelastic commodity? Inelastic means when price goes up, it does not affect demand. It's uranium. Uranium is the least inelastic demand. Did I say that right? Most inelastic? It has the least impact to price changes, I think. So we are at incredible valuations. Now, I know a lot of people have seen some of these and they've gone up quite a bit in uranium. And I've got a uranium one here. I just yanked one up. I yanked up. I was doing some more analysis and I've got deep yellow behind me. And I'll zoom in here. So I've got SM Energy on the left-hand side. You've got the two humps. You've got 3, 4, 5, and then the nice big move higher here. On the right is deep yellow. This pullback is the same as this pullback. And we went all the way here. I've got the little arrow here to show you guys, and I'm zooming in on the bottom here. This is the 1-2 hump. It comes up, it goes sideways for a while, which is, these are two different time scales to let you guys know. Two completely different time scales. This is from 97 to 2021. This is from 2020 to 2021. Remember about Elliott wave. Remember about patterns repeating. This is 3. 4 is this. That's this. This here is this guy here, and it comes up to 4. And we're coming down and doing number 5. Number 5 has the trait, the characteristic trait of this little bottom right here. We are at this bottom portion, and I'm expecting a launch higher from this very high level, a launch. Guess what? Deep yellow has the same pattern as SM Energy does to the T. 1, 2, the two little humps. 3 is the sideways movement, and this is on a very short-term scale. 4, 5, and we're about to launch higher. It's the same as this one. It's a little bit, just after 2020, this one's a little bit different. Well, after, this one's doing it a little bit faster than this one. And all these companies, I'm showing you just these, they all have it. Solar has it. All of the uranium companies have it. A lot of the oil exploration and energy service companies have it, and natural gas. What's the likelihood that these are all wrong? We've got the golden monetary base looking like it's about to break to the upside based off of where we are in the consolidation pattern. We've got all the valuations to extreme 100-year lows. Now, when you look at the pattern repeating over and over, this pattern that I have in the upper portion here, remember the two moves up. And I'm just trying to put perspective here. So when you look at this pattern here, it's going to create another pattern. That's a pattern of a bigger picture. So when you zoom in and zoom in and zoom in, you have to zoom out, zoom out, zoom out. What if this pattern right here that we are creating, this first one, is actually number 2, where number 1 is here, number 2 is here, and then we blow way higher. there's a chance that we could be at $60 to $80 up here in 2022 with the gold to oil ratio still in the 20s, screaming a screaming buy. And that number 3 hasn't even come yet, or 4 or 5 or the top. If we go, and I'm just throwing out numbers here. Let's say we go to $300 oil, $7 a gallon of gas because we have problems with inflation. Everyone thinks that's not possible. I think it's likely. History repeating itself. This could be a move of number 2 in a big, huge, grand scheme of things. And that the peak is really 10 years away, 8 years away, 10 years away. So this stock, I'm just throwing a number out there, could be a $400 or $500 stock. I don't know. It's possible. With the valuations at 100-year lows, it means inflation's in the system. It went all into stocks and bonds. And if interest rates reverses this move, it could be bigger than what most people think. And I'm not telling you that this is necessarily going to happen the way I'm describing it. And maybe I'm crazy for thinking this. Maybe I am. Maybe I'll be wrong. But I can tell you the data is pretty compelling. It's very interesting to look into this stuff because the alignment is crazy. And the move at how fast this is doing it on SM Energy over here, it's crazy. But if 1 and 2, if this is 1 and this is 2 coming up, imagine what 3 is going to be. I mean, it's going to put us way up here. If that is, I don't know if it's going to be. We have to look at the valuations. We have to look at that gold to commodity ratio. We have to look at gold to oil and gold to uranium. We have to look at those ratios. We have to see what the gold to monetary base is doing. But I can tell you this, we haven't even broken out of the gold to monetary base. We're still in the channel, and these things are basically doing massive lead-ins. What if 2 is where we're at today? And 1 was this little guy down here. That means the big move hasn't even come. And I'm going to be walking into the big move with a 20 bagger already or a 30 bagger. And what if that big move comes and does another 10 or 20x from that? I don't know. Maybe it's possible, maybe it's not. I'm just throwing stuff out here. Your guys' paradigm is looking at 2000, 2008, which is literally this little blip here. That's it. In a declining interest rate environment. If this changes, it's going to rotate a massive amount of money. It's going to be big time. And what's driving it, in my opinion, is that this guy here, the 4 million home deficit we have in housing. And that's why housing is going vertical. And most retail sectors get this wrong. And most of the people on YouTube, they're probably going to get it wrong, a market top in real estate and all this stuff. And markets climb a wall of worry. How many people are in commodities? It's like no one. I don't know anyone. They're all in stocks. They're all in crypto. When all this unwinds and they all jump into this, we'll see where it goes. But I'm not saying that these things are going to this level. What I'm doing is I'm challenging your paradigm. I'm challenging the way you're thinking. That is what I want you to get from this clip. I'm challenging you to think differently, that the past 40 years may not be a prelude to what's coming ahead of us. It may or may not. Some people will say, oh, it's just going to continue to decline. Well, expansionary phases, it usually doesn't continue to decline. If we break out of that descending wedges break to the upside for the most part. That descending wedge we have right here, that breaks to the upside. And we're at the end of that consolidation period, which we've seen on Bitcoin. We've seen on all these other patterns. If that goes up, we're going to be laughing. We're going to be laughing at how much our accounts are going to go up over the next 10 years. We're going to be like giving high fives. I mean, just start adding zeros. It's going to be funny. And hopefully it plays out that way. It's not guaranteed, but I'm challenging your paradigm today. And I'm saying that we're probably going to see rising interest rate environment. They're going to try to hold it down, but they're not going to be able to. This is structural. This is big time structural. There's too much money in the system. And I don't care where they're going to try to manipulate everything they can. They're going to try to hold this all up. And I don't know if they can do it. We'll see. Money's going to flow to where the value is. And eventually people are going to figure this out. All right, guys, hopefully you like this, this clip, this content here. Give me a thumbs up button. Subscribe to the channel if you haven't already. And thanks for listening. This is Finding Value.